The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone. Welcome to today's presentation. The focus of the presentation today will be the employer contribution tax credits and specifically how those credits are applicable to owner-only retirement plans. A quick disclaimer, the information in this presentation is not intended to be legal or tax advice. If you're looking for legal or tax advice, certainly consult with a qualified professional such as an attorney or an accountant. The target audience for today's presentation will be advisors that work with owner-only defined contribution plans, 401k plans, etc., and specifically those for which NOVA is the third-party administrator. Quick overview of the agenda. We'll do a quick hit on Secure 2.0, a review of the tax credits that are available to retirement plans, and a deeper dive on the employer contribution credit, specifically as it relates to owner-only retirement plans. So a quick introduction to Secure 2.0. Again, you've probably heard me say this before, but if you're an advisor working in the industry that does any type of retirement plan business, you've been inundated with information about Secure 1.0 and Secure 2.0. Again, Secure 2.0 is the probably more massive piece of legislation that was passed in the waning hours of 2022. Some of the provisions in theory went into effect kind of immediately, but from a practitioner standpoint, in the industry, we're just waiting on guidance from the IRS to actually figure out how to implement some of these new provisions that are going into effect. So December 20th of 2023, the IRS released a quote-unquote grab bag of guidance in IRS Notice 2024-2 that address a ton of the just technical information that the industry is looking for with regards to how to effectively implement some of these new provisions that will impact our retirement plans. From a Secure 2.0 standpoint, as it relates to owner-only retirement plans, again, there's a big impact from the application of Roth employer contributions. If you have any interest in that topic, again, there's another great presentation on our channel that I'd encourage you to go check out. And then again, there are some additional tax credits that are available that are worth covering, both an automatic enrollment tax credit and a employer contribution tax credit, which will be the focus of today's presentation. So just an overview of the Secure 2.0 tax credits overall. The first credit is for essentially offsetting the cost of establishing and operating new retirement plans, very specifically new plans. There's always been an incentive from the IRS to establish retirement plans. The incentive initially came in the form of deductions. Over time, there were smaller tax credits available to help offset some of these startup costs associated with retirement plans. And Secure 2.0 really enhanced those startup credits that are available in the first 3 years the plan's in operation to the tune of up to $5,000 per year. Again, not the focus of today's presentation, as that credit's not applicable to owner-only plans. But if you have questions on that topic or working on an opportunity where that'd be applicable, we'd certainly be willing to provide some guidance there for you. The automatic enrollment credit, again, this is available to both owner-only plans and quote-unquote real plans that are sponsored by small employers. Not the focus of today's presentation, and again, in a nutshell, the automatic enrollment tax credit is up to $1,500 spread out over 3 years, so $500 per year, starting with the year that feature is added into the plan. But the employer contribution credit, this is a new credit that was established as part of Secure 2.0. And again, this is available to both owner-only plans and to those plans that are considered small employers that do have employees. Again, I wouldn't be a TPA salesperson if I didn't geek out on the code a little bit. So, code section 45E, section F covers the establishment and kind of the legislative text associated with the new employer contribution credit. The credit is applicable to defined contribution plans sponsored by quote unquote small employers starting with the 2023 tax year. Ultimately, any of these credits are designed to mitigate the cost of establishing retirement plans, or in this situation, the cost of funding employer contributions for retirement plans in the first 5 years of plan operation. So the employer contribution credit, who qualifies? Again, small employers, it's very specifically defined by the IRS as an employer who had no more than 100 employees who received more than $5,000 in compensation in the preceding tax year. One important point to note here is the employer must be considered an eligible employer in year one to claim the credit in any future year. And I'll give you an example of that here in a minute, but again, if I have more, for example, than 100 employees in the year I established the plan, I'm not eligible to receive the employer contribution credit in the future. The credit is applicable for participants with very specifically FICA wages of less than $100,000. And we'll go into detail on that here in a minute. And then again, one other important note is there is no requirement to have non-highly compensated employees in the plan in order to take advantage of this tax credit. So the employer contribution credit and FICA wages, let's dig into that a little bit. Ultimately, the tax structure of a company is going to dictate, how they're quote unquote paid, how they take their income, their compensation, et cetera. This is a very important topic that we discuss with advisors all the time because ultimately we need to understand how a business owner pays himself to determine, the deductible contribution and ultimately the best plan design, right? So an example of, a sole proprietor taking earned income is not subject to FICA, and so would be eligible for this credit. Partnerships with self-employment earnings reported on their K-1, again, those earnings are not subject to FICA, and regardless of the dollar amount, those employees receiving that type of income would be eligible for this credit. Employees paid via W-2 wages are going to be subject to the compensation threshold in a given year. That's 100K initially, but W-2 wages are subject to FICA, and so the dollar amount that employee pays is going to determine whether or not that employee would qualify for the credit or not. So a quick example, let's take a lawyer operating their practice as a sole proprietorship. They have earned income of $600,000. That lawyer is going to be eligible to receive the employer contribution credit because they have no wages subject to FICA. Not uncommon at all to have a small office with an owner and a spouse working together at the office. Let's say in this situation, the spouse is being paid $80,000 in W-2 wages. The spouse would also be eligible to receive the employer contribution credit because the spouse is receiving wages of less than 100K. Another example here, again, taking a doctor that is taxed as an S corporation, might be earning a ton of money, paying themselves from a W-2 standpoint only $125,000. That 125 is maybe a small part of their overall income, but is more than the 100K threshold. And so in this example, the doctor would not be eligible for the employer contribution credit. So we've covered who qualifies. Let's go into a little bit more of the credit itself and how much that credit is. And we'll go through a couple of examples here, and then the timing of actually taking that credit and the value of the credit over time. So the credit itself is the lesser of the value of the employer contribution, or $1,000 per qualifying participant. So just a quick example here, look at the first year a plan was established, and let's assume all participants are earning less than 100K in FICA wages. If for whatever reason I'm a doctor making a contribution of less than $1,000, I make a $900 profit sharing contribution. That $900 is less than the maximum credit of $1,000, so my credit in this situation is limited to $900. Let's take the same doctor and they had a banner year and are looking for the max deduction possible. They've remitted the maximum profit sharing contribution of $69,000. Their credit is still going to be limited to the maximum of $1,000 in that scenario. Again, small office environment. We have a doctor and a spouse both either not having FICA wages or taking less than 100K in FICA wages. They both receive a non-elective contribution of $10,000. The credit is per employee of 1,000, so a total credit in that situation of $2,000. It's important to note that the credit phases out over 5 years, and so the value of the credit in plan year 1 and plan year 2 is 100%. And then over time, that credit phases out, right? So year 3, the credit's only valued at 75%. Year 4, 50%. Year 5, down to 25%. Ultimately goes away in year 6 plus. There's a little asterisk on here, and there is some thought of, at some point, you have to take a look at what's more valuable, right? Does it make more sense for me to take the deduction or the credit in a given year, right? And certainly not unfeasible to see a situation where, a business owner might get a deduction of 30 or 40% for their employer contribution, whereas the credit's only worth 25%. And so in that scenario, it'd probably make more sense to actually take the deduction in lieu of the credit, right? But it goes back to the disclaimer and really a good consulting opportunity for you guys from an advisor standpoint to discuss the strategy and engage with the CPA to figure out, what's the best to claim in a given year, especially in that situation. Again, first item here is to make sure that the CPA is aware that the credit even exists. It's a new credit. Even if you're working with a CPA that's familiar with retirement plans in general, they may not be familiar with this credit, and especially the idea that this credit is available to owner-only plans. So a good opportunity to network with the CPA and bring it to their attention, especially if they're not aware of it. With regards to how really all these credits are claimed, it's on Form 8881. If you've written a startup plan with Nova in the last couple of years, we generally send that out to you as an advisor, encouraging you to work with the client and the CPA to claim all credits that are available, and we'll continue to do that in future years. Another interesting note about this employer contribution credit is the credit is available for tax years starting in 2023, but it's actually available for plans established prior to 2023. And so looking at a quick example of a plan that was established in 2022, the employer contribution credit did not yet exist, and so no credit would obviously be available for the 2022 tax year. Going into 2023, again, the credit is available and cascades out over time. So 2023, we get 100% of that credit, 24, 75%, 25, 50%, and again, 26, 25% if it makes sense, right? But it's a little bit of a quirk in the way the reg's written, but certainly an opportunity for those newer plans to still take advantage to a certain extent some of this credit that's available. An important item to note here is, again, no double dipping. This is true of all credits versus deductions, right? But as an employer, I can't both claim credit for the contribution and also deduct that same contribution in a given tax year. So it's one or the other, right? And again, any amount that is not eligible for the credit can certainly still be deducted. Another important item here is the credit is applied to the tax year in which the deduction would apply, right? And so in our business, we're often looking, we're allocating contributions after the end of the year that are applicable still to that prior year from a tax standpoint. So quick example, for a 2023 plan that's making their contribution, let's say in April of 2024, that contribution is allocated in 2024, but is deductible for the 2023 tax year. In that same situation, the credit would also apply for the 2023 tax year. So just a point of clarification there. Employer contribution credit, and then specific items related to Nova. Again, for 2023 plans that have yet to file their taxes, they're certainly eligible to take advantage of the employer contribution and get the deduction or the credit that is available to them. If for some reason you're working with us on an owner-only plan that has only made, for example, deferrals in the past, and they have not yet made an employer contribution, just a reminder that we do charge $100 per money source in the plan. And so, employee deferral counts as one money source. An employer non-elective contribution would count as an additional money source. Just point that out so there's no surprises. That's certainly covered in our fees, et cetera, that are outlined to the plan sponsor, but just a reminder there, if you have somebody taking advantage of that contribution for the first time, there will be an additional $100 fee. Just some housekeeping items related to just contributions and data overall. From our standpoint, our turnaround time from the time data is submitted is a minimum of 3 weeks. And so again, we start sending out notifications in early January. You guys are copied on all of that communication. If your sponsors have yet to turn in that information, I'd encourage them to get it in as soon as possible so we can get those calculations turned around and get deposits made. Fees that nobody likes that are really more annoyance fees on our end, because plan sponsors sometimes don't pay attention unless we threaten them with fees. But There would be extension fees and expeditious fees that will come into play at some point if the plan sponsor is not returning data to us, right? Ultimately, they've hired us to handle the compliance items on behalf of the plan, and we need our data in order to do so, right? So for plan sponsors that do not return data to us by June 1st, we will be extending their Form 5500 filings, and there's a fee of $250 for that extension. For plan sponsors that return data to us after September 15th, we're at crunch time at that point, have a month to get everything done, and there will be a $300 expeditious fee that is applicable in those situations. So just a reminder there. For those plan sponsors that are not yet subject to the 5500 easy filing, but have yet to return data to us, starting in mid-July, there'll be a data follow-up fee of $50 a month. Again, more of an annoyance fee. Please just encourage your plan sponsors, if you're chatting with them and they haven't returned this data into us, to get the data in. If they don't know exactly what they're looking for or what's outstanding, give us a shout. We'll, double check the system and work with you and the client to make sure that they understand what the outstanding items are. The employer contribution credit and opportunities for you guys from an advisor standpoint. Again, big ticket item that we just covered is please remind the plan sponsors to provide us accurate compensation information in a timely manner. And I'll focus on accurate there for a minute, right? Because if the plan sponsor is giving us ballpark information, that could have an impact on whether or not they would, for example, qualify for the employer contribution credit. So giving us very accurate information with regards to the amount of compensation and how they take the compensation is very important. And again, if the business owner is changing the organizational structure of their company, during the year, keep us in the loop on that. There's some ramifications from a document standpoint where the document needs to be amended to properly reflect the corporate tax structure. So, for example, if I'm changing from a sole proprietorship to making an S corp election in a given year, we need to know about that. There's also some consulting that we can bring to the table along with you guys from an advisor standpoint with regards to the impact of changing from, for example, a sole proprietorship versus making the S corp election and the amount of W-2 that the business owner is paying themselves and the impact on the deductible contribution tied to those forms and amounts of compensation, right? So any of those changes that are on the horizon, loop us in if you're not comfortable having that conversation by yourself, and we'd be happy to provide that guidance along with you to the plan sponsor. And again, I've mentioned this on majority of presentations that we do here that are specific to these kind of credits where a CPA would be involved. I would encourage the CPA to take advantage of all the tax credits available, whether it's the administrative credit for non-owner-only plans or the automatic enrollment credit if applicable, or in this situation, the employer contribution credit. But from what I find, a lot of CPAs are just unfamiliar with these credits in general. So it's a great opportunity for you as an advisor to engage with the CPAs, do some networking, bring some value to them so they can maybe identify other opportunities that could also take advantage of these deductions and these credits on behalf of their other clients. So with that being said, that's the end of the presentation today. Hope you learned something there. As always, if you have any follow-up questions, feel free to reach out and look forward to hearing from you. Thank you.